Hello and welcome to Big Deal. I'm Nisha Poddar. Now on Big Deal today, we are joined by the industry players in the private credit space, which is, remember, gaining momentum with more demand for the structured, differentiated loan as more and more players enter this space to solve for the gap left by the banks and the NBFCs. Let me welcome on the show right here in the studio Kapil Singhal of True North, Amit Agrawal of Edelweiss Alternatives, and Piyush Gupta of Investec. Gentlemen, so good to have you in our studios in CNBC-TV18. Welcome to CNBC-TV18. Now, Piyush, starting with first, why this huge influx of many players coming into the space, and how's the demand scenario looking?
So, I think, Nisha, globally, private credit asset class after the global financial crisis really took off because of heavier regulation of banks, stricter capital requirements for mid-market lending, etc. India has been no exception, and particularly after 2013-14, when the NPAs issue surfaced. It's NBFCs which stepped in to take away that market share across wholesale, retail, etc. But after the IL&FS-related events in 2018, I think the business model of wholesale lending NBFCs, which was heavily dependent on, taking leverage on the books and running some ALM gaps, etc. So, because of which, the wholesale NBFCs have had to take a back seat and give away space. Credit funds, credit mutual funds have also are down to like 1/3 of the AUM they used to have until 2018. So there is that space vacated by banks, NBFCs and credit funds on one side. Secondly, the corporate bond market in India hasn't really evolved to the extent it is in some of the more developed markets, or even some of the more emerging, some of the peer emerging markets.
Right.
So it's still very restricted below AA rated corporates, etc. And the third dimension is the regulatory restrictions. So banks, for example, in India are not allowed to finance domestic mergers, acquisitions, or stake buyouts, etc. So the demand drivers include, non-bank end use, for which borrowers cannot go to banks, or for low-rated corporates who have viable businesses, have bankable, credit profiles, but don't have access to corporate bond markets, or are really not getting proper solutions from banks and other traditional capital providers.
That's right.
And lastly, I would say, banks, or for that matter, NBFCs, or any traditional form of debt capital providers, or even corporate bonds, compared to that, non-standardized, more flexible, bespoke, solution type of debt financing, that's typically,
so more tailor-made, more flexible, more to solve the purpose, and mostly are short-term in nature as well, as I've seen, at least for this year into 2023, whatever deals have happened have been for a tenure of 2 to 6 years. So that's also one. But from what you said, a differentiated product and many aspects that we can delve further into. Kapil, you are in the midst of raising funds. Now, it's an AIF product, and where the investor is quite informed. They know the risks that they are taking. What is it that is interesting the investors, and what is the interest level coming in from there?
So I'll just first make a distinction, Nisha, that from an offshore perspective, I think we should speak both in terms of what is the offshore interest as well as domestic interest.
Sure.
Offshore interest will be subdued for some time because the MIFOR rates, the global rates have gone up by 400 basis points. And therefore, a typical well-rated company today, like a Blackstone company or a KKR company, will borrow today at 9-10% dollar. And what we are able to offer domestically, net of all fee carry expenses, is roughly the same number, maybe 100-150 basis points over. So for some time to come, offshore interest will be subdued from a tactical basis. People who will still invest in India on offshore basis will be more GP relationships, more long-term strategic relationships, so they will continue to come in India. But an immediate trading kind of trade-offs that, I want to earn a slightly higher returns and invest in India will be limited for some time. But as the rates cool off, and surely they will, in a matter of maybe 2 years, 2.5 years, whatever time it takes,
Yes.
the offshore interest will come back again.
Right.
Domestic market, on the other hand, has been extremely buoyant in the last 2 years.
Yes.
And especially coming off the regulation changes that happened in the early part of this year. Significant one of them being the tax changes
Yes.
for mutual funds, tax changes for market-linked debentures. It has become a very, very attractive asset class for domestic, informed, institutionalized investors,
Yes.
and working with a set of managers like, two of my counterparts here, our
Yes.
platforms.
Yes.
So they feel comfortable working with us, and there is a huge amount of interest.
So it's a domestic pool of capital also for infusing the growth
Absolutely.
capital in our own companies, which has been one of the prime aspects of IBCA's efforts.
Absolutely. That has what has been driving the
Yes.
private credit growth
Yes.
in the last maybe 1.5 years.
No, domestic pool of capital and getting advantage over the foreign investors for a change, because the spreads are not now in their favor. So that can tilt any moment, but that could be one of the very big reasons why it makes for a lucrative
There is a 500 to 600 basis points delta today in terms of what, let's say, three of us are able to offer compared to a typical debt mutual fund product.
Yes, but that's
meaningful
cyclical, Kapil. At the moment, it's lucrative, but that can change.
Not really. I mean, it's not. It's a matter of debate. I wouldn't want to, drag this conversation into that direction. But I would say that it's a reasonably stable delta.
Yes.
Private markets are reasonably inelastic when it comes to repo rates.
Yes.
They continue to play within 100, 200 basis points. They don't change dramatically.
Right. All right. So that point made. So, Amit, your institution has been in this business for so many years. The kind of products, the differentiated products, and right now, have they evolved according to the needs of the industry? Give us a sense of the products and the demand coming in.
So I think as Edelweiss Alternatives, we have been in it for 12 years, and we have seen the products evolve over a period of time.
Yes.
What started as maybe $100 million fund, today we have more than $1 billion funds in each of these categories. And the categories are fairly simple. They have to cover the entire credit risk spectrum. What private credit funds offer is actually superior risk-adjusted return. So when you adjust for the risk that these funds are taking, that is slightly superior return out there. The products, if you think, are mostly aligned around the return ranges.
Yes.
So the return ranges could be 14 to 16%, could be 16 to 20%, could be 20% plus returns.
Yes.
So the products, whether you call it performing credit, whether you call it super performing credit, real estate credit, or special situations credit, all the products have takers. The key thing, and which is what Kapil and I like to add to Kapil's statement, I think the domestic clients, and you also said, are quite savvy. They quite understand. They are going after established platforms with established risk mitigation practices and people who have given performance and track record. So if you have said that you will be 14 to 16% return and you are 15, they will come in your onward fund.
Right.
So performing credits typically are anywhere between 14 to 17% return. You could have a more bespoke solution called structure credit funds or maybe real estate funds, which could be in the range of 17 to 20%. And you could have special situations fund offering more than 20%. But the clients look at the risk, what I should say, mitigation when they invest in a platform. And what, like for example, Edelweiss has 60 investment professionals on the private credit side, but we have around 100 other people around operations and risk management. So people are looking at who is the asset manager who has delivered. So if somebody has said 14 to 16 and he delivers, he gets money very well in his next fund. Somebody has said 20% plus and he delivers 17%, he does not get the next chunk of money. So they are quite aware of what a product manager is speaking, and they play across the spectrum depending on their risk appetite. So a client might want some money in the 14% category. Some client may say, okay, this is my high risk capital, I want only 20% plus return. And private credit as a part, so India does around 200 lakh crores of credit. The book currently is 200 lakh crore order of magnitude. Private credit is hardly 1.2 lakh crores. Which is like 0.6% of the total credit is sitting in private credit.
So therefore, a huge headroom of growth that is probable also in the industry. So Piyush, of course, the pricing is mentioned. These are very high interest rates, right? Do you think the understanding from the company is good and evolved now at these rates? Of course, the NBFCs played a huge role in the middle, and the place that they have vacated also is in some way covered by the private credit space. Now, how easy or difficult is the conversion at these price points most of the times?
Well, so, just to give you a little bit of backdrop and context here, so there are, if we look at just pure mid-market corporate landscape in India, there are more than 3,000 companies. If I just take very narrow tram lines of $50 million to $500 million top line.
Yes.
These are companies with operating, profitable track record history with at least 50 crore EBITDA. If I stretch it, the tram lines to $1 billion top line, it gets bigger and bigger. There's about domestic M&A of $60 billion, give or take, every year happening, for the last 4 years on an average. The mid-market part of it, the debt financing part of it would throw up another, 20-odd thousand crore of financing opportunity every year. There's stake buyout opportunity. There's $7 billion of private equity sponsor exit happening every year on average for the last 4 years through private markets.
Right.
Some of which will require debt financing. So I think just within the performing credit space, there's a good 40, 50,000 crore per annum of opportunity, which is not serviceable by corporate bond market or banks, or for that matter, a lot of NBFCs.
Yes.
And therefore, there's a reason why the pricing is what it is.
Yes. All right. So the risk assessment is something that we will talk about. I want to understand that.
I would like to also add a small thing here.
Sure.
It's not purely debt pricing also at all points of time. Sometimes this is equity upside sharing. Sometimes this is sharing in the growth. Sometimes it is baseline, which is fixed at a certain lower level. And then you are making more returns if the company's EBITDA grows.
Yes.
So these are not specifically, if you think of it in terms of, it is participation in growth, which otherwise would not have happened if that money was not available.
So we know of these products. Of course, one of the big private equity, foreign private equity funds had dealt with this. The mezzanine lending was being used as a cautionary thing, but then it did burn its fingers in that particular product as well. So we'll talk more about the regulatory aspects, the tax aspects, as well as the risk assessment aspects of private credit right after this very short break on Big Deal. Stay tuned.